Why does a simple cup of coffee today cost 10 times what it did 50 years ago? Why is it that, despite rapid technological advancements that should make production cheaper and more efficient, the cost of living in London, New York, Sydney, and Berlin continues to climb relentlessly? You might assume this is merely corporate greed or a temporary supply glitch. But the reality is far more systemic. Why does the currency in your pocket physically buy less every single year, regardless of how hard you work to earn it? This is not an accident of the market. It is a feature of the design. How does a mechanism intended to stabilize the economy end up eroding the very wealth it is supposed to protect? To understand why prices go up, we must first ask, why is our money designed to go down? Why do we accept that a house bought by our grandparents for the price of a modern luxury car is now worth millions? Why do central banks in the United States, Canada, and Europe explicitly target a price increase of 2% every year, effectively planning for your savings to lose value? The answer lies not in the goods we buy, but in the nature of the money we use to buy them. This is the story of inflation, not as a statistic, but as the invisible engine reshaping global society. This video is not about prices going up. It's about why the system requires them to. Why does this trend matter to the average citizen in a Tier 1 economy? Because inflation is the single biggest factor determining your long-term quality of life. When prices rise faster than wages, as they have in the UK housing market or the Canadian grocery sector, the standard of living quietly collapses. Why do young professionals today struggle to purchase homes that their parents bought on a single income? It is because the measuring stick for value, the currency itself, is shrinking. How does this impact global stability? When money loses its purchasing power, it forces everyone, from pensioners in Germany to investors in Australia, to take higher risks just to preserve what they have. It changes human behavior. Why do we see a surge in speculative assets and high-risk investments? Because leaving money in a bank account is mathematically guaranteed to result in a loss of purchasing power over time. This is not just an economic issue, it is a social one. It dictates who can retire, who can afford education, and who remains trapped in a cycle of paycheck-to-paycheck survival. Why is this phenomenon nearly universal? Whether you look at the euro, the US dollar, or the Australian dollar, the trajectory is identical. Since the early 20th century, almost every major currency has lost between 90% and 99% of its purchasing power. Why does the system require this constant devaluation to function? To answer that, we must look at the mechanics of modern money. How does inflation actually happen? Imagine a closed room where 10 people are bidding on a single loaf of bread. Each person has exactly $10 in their pocket. The maximum price that loaf of bread can sell for is limited by the total amount of money in the room. The price will likely settle at a reasonable equilibrium based on how hungry the bidders are. Now, ask yourself, how does the situation change if a central authority walks into the room and hands every person another $100? The loaf of bread has not changed. It has not become more nutritious, larger, or tastier. The supply of goods remains exactly the same. However, the supply of money chasing that good has exploded. Why does the price skyrocket to $50 or $60? Not because the bread is worth more, but because the currency is worth less. This is monetary inflation. How does this translate to the real world? In our global economy, the room is the country, and the authority handing out cash is the central bank. The Federal Reserve in the US, the ECB in Europe, or the Bank of England. When governments need to pay for infrastructure, wars, or social programs, they often cannot raise enough through taxes alone. Why? Because raising taxes is politically unpopular. How do they solve this funding gap? They borrow money that is created out of thin air. When the supply of money increases faster than the supply of goods and services, like cars, houses, and apples, The prices of those goods must rise to absorb the new cash. Why do we call it inflation? Because the money supply is being inflated like a balloon. The rising price tag at the supermarket is merely the symptom. The disease is the dilution of the currency supply. Why does history keep repeating this cycle? Why don't governments simply stop printing money to keep prices stable? The answer lies in the fear of the alternative, deflation. Why is deflation, falling prices, considered a nightmare by modern economists? In a debt-based system, if prices fall, the real value of debt increases. How does this trap the system? Governments and corporations globally carry massive amounts of debt. If the currency becomes stronger, meaning prices go down, paying back those debts becomes harder. A government that owes trillions cannot afford for money to become more valuable. Therefore, the unspoken mandate is to ensure the currency becomes slightly less valuable every year, making old debts easier to pay off with cheaper new money. Why is the target almost always 2%? You will hear the Federal Reserve or the Reserve Bank of Australia mention a 2% inflation target. Why is 2% considered the Goldilocks zone? The theory suggests that if people expect prices to drop, they will stop spending and wait for a better deal, causing the economy to freeze. By ensuring prices constantly rise, central banks incentivize you to spend your money now rather than hoard it. They are engineering a system where holding cash is penalized. Why do supply shocks exacerbate this? While monetary expansion is the baseline, external factors like oil shortages or supply chain breaks, as seen in the post-2020 era, act as accelerants. How does this work? If the factory cannot produce cars because it lacks computer chips, the supply of cars drops. Even if the money supply stayed the same, prices would rise. But when you combine a drop in supply, fewer cars, with a massive increase in money, stimulus checks and low interest rates, you get the perfect storm for rapid price increases. So far, we've seen that inflation isn't random. It's a structural choice. How do experts justify this endless cycle? There is a deep divide in economic philosophy. On one side, we have the Keynesian view, which dominates current global policy. Why do Keynesians believe inflation is necessary? They argue that government intervention and monetary stimulus are essential to smooth out the boom and bust cycles of the economy. To them, a little inflation is the grease that keeps the economic engine running, preventing high unemployment during downturns. How does the opposing view differ? The Austrian School of Economics and proponents of hard money argue that manipulating the money supply causes the very instability it tries to cure. Why do they view inflation as immoral? They see it as a hidden tax, a transfer of wealth from savers to debtors and the government. They argue that if money supply remained fixed, prices would naturally fall over time due to technology making production more efficient, as we see in the computer industry. Why is there such a discrepancy between sectors? Why do televisions and smartphones get cheaper while healthcare and education skyrocket? The hard money experts argue that in sectors with less government involvement and high technological innovation, deflation, lower prices, naturally occurs. In sectors heavily subsidized or regulated by government spending, where the new money flows first, prices inflate. This is known as the Cantillon effect. What is the Cantillon effect? It explains how the new money enters the system. When a central bank creates money, it does not magically appear in everyone's pocket simultaneously. It goes to banks and the government first. Why does this matter? These early receivers of new money get to spend it before prices rise. By the time the money trickles down to the wage earner, prices have already adjusted upwards. The experts critical of inflation argue this is why the wealth gap widens during periods of high inflation. Why is this trend dangerous in the long run? We are witnessing the financialization of the global economy. How does this manifest? When money is cheap and plentiful, it flows into assets like real estate and stocks, creating bubbles. In Canada and Australia, housing markets have detached from local wages. Why? Because houses are no longer just places to live. They are life rafts for capital trying to escape the erosion of cash. How does this affect the social contract? If a teacher or a nurse cannot save their way to financial security because the bank interest rate is lower than the inflation rate, the incentive to work hard diminishes. Why save $100 today if it will only buy $90 worth of goods next year? This pushes society towards short-term thinking and high-time preference. We consume now rather than build for the future. Why is the debt cycle nearing a breaking point? As interest rates rise to fight inflation, the cost of servicing government debt explodes. The US government now spends more on interest payments than it does on its entire defense budget. How do they pay this interest? By printing more money. This creates a feedback loop. Print money to pay debt dash, cause inflation dash, raise rates dash. Increase debt costs dash, print more money. Why is this a global synchronicity? In a globalized world, no country is an island. If the US dollar inflates, it exports inflation to other nations that hold dollar reserves or trade in dollars. Why do developing nations suffer most? Because their currencies often collapse against the dollar, making imports of fuel and food impossibly expensive. The pain of inflation is not evenly distributed. It punishes the poor and the saver, while rewarding the debtor and the asset owner. Why do we assume the money we use today will exist forever? History tells us that no fiat currency, money backed by nothing but government decree, has lasted indefinitely. The average lifespan is often less than a century. Why should the dollar, the pound, or the euro be any different? How do we break the cycle? Perhaps the solution lies in understanding that price stability is an illusion in a system built on infinite expansion. As technology fights to pull prices down, the monetary system fights to push them up. You are living in the friction between these two forces. Why does the price keep going up? It is not because the world is running out of things. It is because the world is drowning in money. The price tag is a lie. It is the measuring stick that is broken. The question is not, why is this getting expensive? The question you should be asking is, what is my money actually worth? Or, if money keeps changing, should we measure our future in currency? Or in something else? And if the answer keeps changing, how do you plan for a future that is priced in a dissolving currency?